everybody. Thanks for coming in a more or less holiday weekend. It's my great pleasure to have my colleague and friend Luca Taschini talking about one of the topics he's developing on climate finance in particular, whether carbon default swap. We're going to reveal something about the risk of the transition.
Excellent. Thank you very much. Hi everyone, good afternoon. Impressive turning out, given that it's a bank holiday, so I'm not entirely sure what we promised you. I'll try to keep the bar sufficiently high. This is the joint with Alexander Blasberg and Rudiger Kiesel from the University of Duisburg, Essen, and it's a paper where we're trying to extract information related to carbon risk from credit default swaps. CDS, or credit default swaps, are traditional financial contracts that are used basically to protect yourself against default, basically default in the in a company for which you're potentially lending money. Okay, so let me try to explain you why we're using CDS and what we would like to do with this paper. So whenever we're thinking or considering the carbon risk, we are considering we're trying actually to evaluate the firm's exposure towards regulatory risk. Here is exactly the topic of today's just regulatory risk. And to be more precise, is in fact carbon risk, what we want to discuss. And when you're thinking about this exposure to carbon risk, that involves quantification of how companies will transition from whatever they are in terms of business, in terms of the way they operate, towards a new paradigm, a new regime, where they ideally produce in a different way, cleaner. At the moment, you have quite a remarkable amount of papers that try to quantify this risk exposure, regulatory risk exposure, and again, de facto carbon risk exposure. And they do that using or codifying the exposure via the level of emissions. So they look at the level of emissions of the companies, and they normalize somehow, so they have a relative measure, and then they try to identify that the way that risk evolves in association to stocks, for example, so the returns of the publicly traded companies, or the capital structure of those companies. And in most of those cases, the papers that I'm just to cite a few, there are many more. In most of those cases, those papers consider current, instantaneous, or past level of emissions. They cannot at this stage have an understanding, a very precise understanding of, or quantification and codification of how exactly the company are expecting or promoting their transition towards a low carbon economy. And there's already a recognition of that limitation. There are papers by European Central Bank, in fact, both actually from European Central Bank, Carboni et al., where they say, well, at least we could, for example, consider what the companies promise to do in terms of decarbonization. So there is a recognition that this type of past or instantaneous, contemporaneous information need to be supplemented with some form of what usually you probably read in the literature as forward-looking measure. And what we thought is maybe we can use the CDS that have different maturities, so they have different duration in terms of tenor, in terms of contract. Maybe we can use that and squeeze out some information about the projection of what lenders believe that that particular industry or that particular company to be exposed to carbon going forward. And let me try to explain what we want to do, or what we are doing actually, with a very simple example. This is just, I'm trying to build intuition here. So what we have here, we have two pairs of companies in North America and Europe that are starting more or less from this very same level of credit rating. So these two companies, in fact, are practically identical twins from a credit rating perspective. These two are not really close, but close enough actually to build this intuition, this example. One can be clearly attributed, one of those two companies can be clearly attributed to a family of companies that tend to be considered polluting. In this particular case, this is a ConocoPhillips for North America and Holcim for Europe. And the other one, traditionally, can be classified as a non-polluting, cleaner company. And this is John Deere and Phillips. Now, what we observe anecdotally, this is just anecdotal, I'm just building again intuition, anecdotal evidence. What we observe is that CDS do respond to particular policy relevant, carbon policy relevant events. And this band identified the period during, just before, during, and just after the Paris Agreement. So then when we observed that phenomena, we thought maybe we can use CDS to construct an indicator of how a market-wide, a market-implied indicator of how collectively lenders perceived the risk, the regulatory risk evolves through time. So what we did, and again, I'm just building intuition here, and then I will be more formal in the construction of what we call the carbon risk factor. What then we do is we identify a family of companies that we call polluting company, a family of companies that we call clean companies or less polluting companies. We calculate the median CDS of the polluting company, the median CDS of the clean companies, the green and the brown solid bar. And then the difference of these two is what we call the carbon risk factor. So this evolving solid black line represents a market implied forward-looking perception of lenders with respect to the differential exposure of these two groups of companies. Yeah, is that sufficiently clear? Now, you can also see these in two different ways. This is traditionally, by the way, we're not really inventing anything here. If you look in the classical asset pricing, empirical asset pricing literature, this is how you usually construct a factor. So this is a single sorting factor, and I will show you later how we can refine that analysis doing double sorting. But an alternative way of looking at this solid line, this basically represents the payoff, if you want, the performance of a portfolio where you go long on the clean company and short on the polluting company. Yeah. So this is basically how you would consider to be the performance of such a protection portfolio. You buy more protection for the brown, and you sell or buy less protection for the clean company. Yeah.
And how do you choose who is green and who is brown?
I'll explain now how we exactly construct this carbon risk factor. But that's pretty much what we want. So this is what for us is signal. This is what is for us information, right? Market implied. So we are agnostic. We let the CDS speak to us. Forward looking because we have different tenors. Yeah, 1, 5, 1, 3, 5, 10, and 30 years. And it's also potentially also another very important aspect, high frequency. So this thing is daily. Whereas if you look at ESG type of data, this is usually reported on a yearly basis. Okay. Now, what exactly do we do in this paper? And a couple of very high level messages in terms of results. So as I said, we use the spreads in the CDS and we compute these market implied high frequency and forward looking measure. And then we try to answer these initial questions that I had at the beginning. Who is really perceived to be more or less exposed? Where do you see that exposure to be more prominent? And we also slap a dollar value on that. And the when is if you can think in terms of temporal exposure, if you can think in terms of how you think the different sectors or companies exposure to regulatory risk evolves, well, with the CDS, we can also say something about when things could change or are expected to change. So what are the results? once we construct the carbon risk factor, the immediate question that we need to address is that actually a valid driver? So is this CR factor, carbon risk factor, a relevant driver of the CDS spread itself? And we can actually illustrate that there's a clear relationship between what is the lender's perceived exposure and the cost of default protection. Yeah. So you basically can think about a change, a delta, a change in the CDS. A fraction of that change can be attributed to the way lenders perceived the potential differential exposure to play out in the future. Yeah. So basically, a fraction of that change in CDS could be explained by carbon risk. And obviously that varies depending on who you are, where you are, and when you are projecting so the tenor of the CDS. The carbon risk also, we illustrate that, perhaps a bit intuitive, but at least again, we put some numbers around that. The carbon risk varies substantially across region, Europe versus US. Again, very intuitive, but I would like to give you a little bit of interpretation of that results that I think is quite interesting. There's the classical usual suspects that are obviously more exposed to regulatory risk, but quite interestingly, we can also identify those ones that are actually positively affected by the CR. Namely, there are particular sectors that are considered to be part of a low carbon transition. Namely, if the CR, the risk goes to increase unexpectedly, you would actually expect some of the industries to be the one that provides solutions. Yeah, so you buy less protection because you would expect these guys to do better. And if they do better, they have more cash. If they have more cash, they're probably going to use that cash to meet their debt, therefore lower probability of default, lower demand of protection. And then last, lenders expect higher policy-related costs in the near future, especially in Europe. And this is quite interesting, and is especially interesting in the context, in the debate about what is the role of monetary authority, in particular central banks, when it comes to climate change. Why? Well, if climate change to occur is a problem, but in the long run, actually, it's very difficult to justify some sort of, not intervention, but even debate from a central bank perspective. There are a few papers that suggest that a particular aspect related to climate change, namely regulatory risk, could be potentially a source of systemic risk. And that's more of a conversation. Here, at least, we're trying to test whether an unexpected change in the regulatory risk, represented by a change in the slope of the CDS, could determine a larger unexpected cost in the short versus medium long term. Yeah. So that means that if we do observe something, that could justify empirically the potential systemic risk source of regulatory risk. Okay, so a bit of a theoretical arguments that back up intuition. By no means this is something that we're going to test. This is just a way of using the classical canonical Merton model to justify why we do expect this differential exposure through the lens of regulatory risk. So these are typical dynamics that you have when you consider a dividend-paying stock. Delta is typically considered to be the instantaneous payment of the dividend for the particular company V, and this is the dynamics of the value of the firm. Now, interpret delta now not as a dividend, but as something that we call the actual carbon tax credits. So something that is unknown because we don't really know what is that. You don't really know how much you will be producing, how much you will truly be charged in terms of a fictional cost of carbon. And it's actually in the sense that it's instantaneous, right? It's instant. And that clearly reduces, because it's a cost, reduce the value of the company. Reducing the value of the company has an effect on the probability of default. Now, our reason, our very simple logic is you can identify the two families of the companies. The P stands for polluting, C for cleaner. And the intuition is that if you're in the polluting category, potentially you're subject to a higher level of actual carbon tax rate versus the case vis-a-vis the case of a lower actual carbon tax rate. And that could be mapped into an order of the probability of default. That's the very simple logic that we're applying here. Why do we frame this in the context of Merton? Is because we hope that using this logic, that is the classical logic used in credit risk tests and credit risk management task, we can explain a little bit better the potential use of the CR, of the carbon risk factor. By all means, stop me if there's something unclear or you want me to explain.
On that logic, so implicitly it recognizes the fact that carbon pricing, even though you say we don't know what it is a driver or a potential driver for default.
Yeah.
Which
yes.
At the margin. That is what I was saying. So we may have, even though we believe that, but someone may ask, still, so far we haven't seen anyone defaulting by saying, well, the extent of the climate regulation was so big that
British Steel is an example. British Steel was savaged, was saved by the UK government from default because they didn't have the cash to buy for their analysis.
this was explicit in the reason to default. And this comes also to my second part of the question at the beginning. So although we don't know what it is, this threshold such that there may be a default, but still I think that in Europe, the argument is different, right? Because we do have something that is quite explicit.
Yeah, and you will see that's the way we interpret the results. So to Anna's point, in order to see exactly that fractional contribution I was talking about, we don't run the classical OLS, ordinary least square, but we do a panel quantile regression. And by doing a panel quantile regression, we're basically trying to quantify the effect on the quantiles of the entire distribution of the CDS. And you will see that actually the effect of a change in the effect of a change in the CDS, in the spread of the CDS, the effect of a change in the CR, sorry, in the carbon risk factor on the CDS is extreme in the tail of the quantile. So to the point Anna's asking is, if potentially, if you have a very large change on your CDS, meaning that your probability of default is basically jumping, potentially the change in CR has a larger effect because it's usually considered to be like a draining on your cash. Yeah. And just to very briefly anticipate the results that we have, in Europe, we have extremely strong results of very large effect compared to the North America. We actually lumped everything in. The US is actually North America and Canada altogether. And then strength of the result, the magnitude, sorry, more than strength, the magnitude difference is justified by the fact that 80%, we're still testing that, but 80% of our entities, CDS entity in Europe, are actually compliance entity under the European Emission Trading System. So there is more of an explicit signal, perhaps, and we're doing a little bit more tests there. Versus North America, is more of a projection of some sort of potential global carbon risk. Yeah. Yes.
I got a question in the chat.
Oh,
if
sure.
you want to look at it.
Do you want to start asking your question while I'm trying to?
Yes. The question about this model that is around default risk.
Yeah.
Within polluting industries, I guess that there are some very concentrated sectors and less concentrated sectors.
Yeah.
And maybe what you think that in the most concentrated sectors, there is something like a too big to fail mechanism that companies are so large that even with stronger regulation, they couldn't default.
Possible.
And maybe that there is this type of heterogeneity within the polluting sector between
different
types of markets, I guess.
Absolutely. So when I will show you the sectoral results, I don't yet have in the presentation, but we were discussing these results the other day. You will see very different results, but just on the coefficient of the relevance of the CR. But we were exactly investigating whether we could reconstruct basically a carbon risk factor on a pure just industry by industry. Very simple. I mean, it's just recalculating. And you notice a few things. You notice that certainly concentration plays a role. Importantly, is the level of the level of the pass-through as well. So, for example, utilities seems to be perceived as not too risky, even if you have a higher level of regulatory change. Potentially for the pass-through, maybe also for the implication you just suggested, also because they have plenty of technology that they can use, not necessarily just off the shelf, but they are existing. And they also are not terribly leveraged compared to other sectors like building materials or building materials, or there was another sector that would come to mind. They are highly leveraged with a very large level of fixed assets. So that things will emerge actually in this analysis. Okay, there's a question from Michael. How do you think? Hi, Michael. How do you think of the impeding ratification of the UTS State of Council? Like these results. Michael, I'm going to address this when I will discuss the regional results. Okay. Yes, brilliant. Okay. In the interest of time, very quickly, there's already quite a substantial amount of literature that investigates the effect of regulatory risk on credit, and we only want to consider the credit risk because it's much easier for us to associate the effect of changing regulation on credit. Is quite a much simpler exercise compared to just looking at equity, for example, where there is the effects tend to be weaker because there's equity basically encapsulates so many different types of risks. Okay. So what's the data? We have single name CDS spreads across different tenures. We don't have a huge sample, however, because we're considering single names and daily data, we have a relatively large number of observations. The number of companies for Europe is 130 and approximately 300 for North America. It's definitely much more happening on the CDS in North America than Europe. By the way, also the CDS market are quite different in these two different regions. Our variable of interest is the CDS from log returns. So we consider the difference in the log of the CDS for a particular entity. T is the day, M is the tenure. So we have several different tenure. And later, for the temporal analysis, we will also be using the change in the slope of the CDS in order to say, well, if we have an unexpected change in the slope of the CR, of the carbon risk factor, how this is going to affect the slope of the CDS. And M and N represents the horizon that you are considering, right? Okay, so now to your question, you were asking how exactly do we construct the CR? So the carbon risk factor is defined as the difference between two families of companies. Mean spread of companies that are attributed to P or C, depending on their level of emissions. So this is what I call the single sorting technique. We also do a lot of robustness tests of double sorting, but at the moment we would like to have the most simple message that just with a very simple single sorting. What is that sort? What is the dimension of sorting? This is the level of emissions. So we rank all the companies based on their level of emission intensity. We can also do, we have later absolute emission, lag effect. We really have a very large and long section of robustness tests. We then take the upper 20%, lower 20%. So the top 20 are the polluting one, the largest emitters. The bottom 20% are the clean one. then we take the median spread of the CDS in these two families, and then we calculate the difference. This particular CRT represents that solid line that I had in my second silly animation. So that's represent the evolution of the market, the lender's perspective about differential exposure, how the two groups, families will evolve in time.
So you also, in your data, you not only have financial data, but you also have the uses of inputs and the level of emissions. Because to actually choose by the level of emissions, it means that you know how emitters.
Oh yeah. So this is just to give you. So we don't have
reported emissions.
Yes. So we consider. So this is the list of for a particular year, because companies also can actually move in from few to move the non-solid, the non-bold ones move sometime in and out the different families. We don't have financials sector, but we do have all the financials performance information, and we have obviously we have emission information, scope 1 and 2. Of all the companies, of all these companies. These are really, really large companies.
So you also have which are paying, which are actually most are in the ETS. So you have in the ETS and out of
we can
tell
out of this list, we can tell, we know exactly which one are compliance companies and which are not.
Okay.
Yes. You have a question? No, sorry. I saw. Sorry.
I think that this answers my question. So it's
Okay.
Just curiosity about, since you show that all seem to is perceived sometimes as a polluter, sometimes as someone within the cement sector, as someone who is really upfront in the technology where it goes.
Yeah, excellent question. So
I see you'll see also in portfolio that are let's say compliant with the Paris-based indexes. So there are a few sectors where it's a lot of ambiguity.
Point taken. So I am usually the one that says that it's extremely reductive to say that you have heroes and villains by just categorizing companies based on the level of emission, but de facto is what we basically do here. So purely based on the level of emissions, we can identify companies that are simply large in level of emission intensity, and other companies that are small. The case of Holcim will be always systematically polluting. But when we do the double sorting means that we first identify one performance indicator, as Maria Eugenia was suggesting. That could be, we have here, I think we tested, size, book to market, leverage, and we have a few others, but the most relevant are size, book to market, and leverage. This is back to the point I was making earlier. You first identify the very large one, and you construct basically a portfolio of large and small companies. But then you do the second sorting, the classical double sorting that you do in asset pricing, and then you have the large polluting, large clean, and the small polluting and small clean. So there, maybe Holcim might actually, Holcim not, definitely not. Holcim will be the same, the P large probably. But there are companies that maybe jump into a different, exactly, switching into the quantity. Perhaps again, more direct to your point. We spent a substantial amount of word space in the paper to say that out of the traditional transition risk, we are not really able to observe indicators that tell us the evolution of technology. We don't have it because technology is usually adopted or not. We don't see an evolution in adoption of the technology. Equally, we don't see anything that is related to changing consumers' behaviors. So the only things that we see here in terms of trajectory is the level of emissions. So we don't really capture what you were suggesting.
I have also another question in the fact that you use something that is contemporaneous, right?
Yeah.
And this idea of the trajectory is also something that, I mean, you can also see the evolution. And when you say that one of the questions to have one of the interests of having information related to the firm is based on their transition plan.
Yeah.
So how do you internalize this idea that there is something that may change? I don't say drastically or not because of the adoption of some technologies, although, for instance, in the cement sector, this happens.
Yeah.
So, but there's something that is linked to the history. So when you do T, maybe we're not capturing the T-1.
So the results I'm presenting actually are lagged results. So we consider the T-1. In fact, what is the -1? I think is debatable here.
Yeah.
Because it would be probably quite clear in the use of rating. The T-1 is last year number, right? Or emission, ESG is the level of emission you were reporting last year, period, right? T-1 is clear, is 1 year. Here, what is that? Is a day, is a week, is a month? How much time do you need to absorb and incorporate that information? But to the point of one way of looking at one way of selling the idea of using CDS is that we can use these to discipline what the lenders perceive to be the pledges of the companies. So I don't have actually here, but we tested because I presented also this to some financial actors because I want to understand whether the idea is decent, exactly, is decent enough or not. And it seems it's okay. And they were asking us, could you actually redo all the analysis just of the automotive sector? And probably they were already anticipating exactly what Anna is asking. So they know that for certain automotive sector, depending on what exactly is the automotive company, the CDS market responds to certain announcement or certain way of presenting the data, right? So in fact, we want to have now a section because we also had a comment about I don't believe there's such a level of response policy. Regulation are changing, but not that frequently. Well, just look at what happened not long ago, the directive of internal combustion engine. And you see, you can. I'm sorry, I don't have it here. But if I plot BMW, Volkswagen, and Mercedes, you will see clearly a response that is differentiated depending on what lenders believe the companies to have in terms of solution. In fact, the Mercedes, I've been told, is sitting on a pile of patents for battery storage.
Yeah, especially for high-level luxury cars.
So there's something that we can truly extract here. And again, it's a way of discipline markets, in particular lenders' perspective about these pledges.
I think that cars are a good case for your paper, because for the other sectors like cement, for example, there is, current emissions and this differential are very interlinked. So somehow you're using this median. I agree that in any case you're demeaning, but somehow the way you sort the firm is very correlated to.
Absolutely. Sure. Absolutely.
Whereas in the case of cars, this is, I think, a very nice application, because this is much more debatable because the emissions are not intrinsic to
the nature of the business. Absolutely.
To the nature of the business.
But to the point the gentleman was asking, I think there are, for building materials, if I plot actually this line for building material, you see a clear response to particular events. And it's because of that concentration in terms of product. So if you're a cement company, you just do that. If you're a steel company, you just do that. Yeah. If you're an aluminium company, you just do that. If I do the same for consumer discretionary and consumer staples, I don't see much. Why? Unilever does a little bit of everything, right? Mm-hmm. So the nature speaks a lot about the use of these.
The problem is the solution.
Yes.
That are not clear.
Yes. So in fact, at the moment, at the very beginning, we immediately disregarded financials. But and now we are revising the paper. in the sectoral analysis, I think we need to be much more careful in discussing our results. I think they're clear cut for certain sector, precisely for the nature of the, due to the nature of the industry and the mechanical construction of our CR. And for others, I think we need to be
Yes, exactly, because of the way you construct.
Yes, yes.
You got a quick question on the chat from Mark.
Hi, Mark. The data is scope 1 and 2. We got it from MSCI True Cost, meaning S&P, and we also tested Bloomberg. They are more or less all in line, and then we decided to go with sorry, not Bloomberg, Refinitiv, and then we decided to stick with the Refinitiv data. The average emission of the water journey may have decreased through time. Would be better to consider time the variant interval. Good point. Good point. I need to think about this. But yeah, thanks for the comment. Is there I need also to the member to write it down somehow. But yes, thanks a lot.
You can
Thank
put
you.
the chat.
Okay. So just to give you a bit of flavor, this is how CR evolves in Europe. This is how CR evolves, carbon risk factor evolves in North America. For different maturity. One thing I think, the only things I could probably quite confidently say here is that you can interpret CR as also a way of considering the credibility of a policy. So CR is always positive in Europe, is a little bit all over the place in North America. So again, my interpretation, so please, our interpretation, so please let us know if we are overstating things or misinterpreting things. But one way of considering that this CR is always systematically and continuously positive is there is a clear credibility of the policy, namely because a lot of the companies are under the compliance system. So it's not maybe just credibility, probably vision and clarity of the message of the signal.
That's surprising, yes.
Yeah. Whereas here, there is a little bit of everything. But again, interestingly, this is a Paris Agreement. This is Trump election. Just again, by no means a proof or a test. It's just a visual inspection that there is some sort of response of this particular type of CR. Yes.
Biden election.
No, we didn't actually identify that. A good point. We've got asked actually to check whether the Inflation Reduction Act has some effect, and I'm pretty sure we will.
Fire in from
The fire, okay. But that's that.
There were big events, not just one day, but big events to illustrate the consequence of elections.
Agreed, but that's more on the physical side, meaning that is more connected to probably the liability that you might have if something happened.
But you can expect there is an increase in the regulation.
Good point. So we have I'll probably go very quick there. We have something that where we test attention. So we basically want to see whether this CR is just probably picking up just attention. Or whether it is truly something. And once we filter out attention, so once we reduce a potential magnifying effect of attention, you've got the fire and the lenders think, okay, well, actually climate is a thing and this company I'm lending money could pay out big time in terms of liability. So I'm going on the market and demand more protection. So we are controlling for that attention.
Just a question on that. What is interesting is that during the period that you depicted, the BTS price was pretty low. So it doesn't depend really on the fact that, so go back to this idea of Merton. So it's not the value, but it is that may trigger something on the quote is the existence of the instrument. Because during that period, I mean, we had something around, I think on average 20 years. So I didn't expect that for even this company that was defaulting because we didn't have the cash to pay the allowances. But at the time, they could pay the allowances for low
there are lower price. We are, now that we are analyzing the case, very specific case of Europe, we are also regressing everything, accounting for the price of the allowances. I think at the moment, to me, this is just, when you talk, I've been talking to a lot of CDS traders. They say that, yes, they know the existence of carbon markets. They know the existence of regulatory risk is margin. Is really much. So at the moment, what we want to do is, we were hoping that at least through their lens, we can detect something that is, again, market implied. So we are agnostic about that. We don't know how much of that information, the true information as in what's the level of the price of the CO2 is. But
no, maybe this is just, I mean, the implicit price of a commitment in terms of regulation, whatever it is, the level is not directly the level that may trigger the default, but the fact that there is also this problem of compliance, commitment, and also eventually a penalty if they are not compliant. So it's much more on the credibility of the instrument than the level of pricing.
Yeah, I understand. I think for that type of analysis, I think it would be probably better if the analysis is on the cost of capital, and you consider all these nuances on the policy. Because you, for example, cement, we were just saying the nature of the industry, explain why they should be exposed. If you really look at the exact how much they get, the amount of the exemptions that they get, and the fact that they control the major ports for import of clinker, you understand basically that.
But at the same time, they have started using
I agree.
clinker
I agree.
because of the ETS.
Yeah, sure.
So it's self-indulgence around around.
This is my concern was mostly on the endogeneity of it all. For what we are talking in the paper, and the way you construct this measure and so on makes it difficult.
There is a stronger relationship due to the nature of
Exactly.
Of the industry. Absolutely.
But whereas in cars, I mean, you would say that this is one regulation, but there are so many other regulations. There are many other regulations. The nature, it's very different. I mean, there are many processes involved. They are very globalized. I don't know. There are many.
Yes, that's true. I mean, this
is changing now, but you end in 2009.
Okay, so. Oh, sorry.
You also see something else from in terms of credibility from the way the curves are ranked by maturity?
No. This was just a very immediate reaction to the fact that everything is zero for Europe, and there's less clarity here. We've been suggested, probably this is what you're aiming to, whether there is a certain speed of response. So instead of looking at this single curve, you're comparing the difference in the curves. Like you compute really the difference and see how quickly you turn back to a certain level. So going back to the case of the automotive, depending on the company you are, some companies just directive boom spike and then immediately down. That means it's just a pure event thing. So the idea of it's just a reaction to an announcement. That's it. Others spike up and then going back to a different level. So
yeah, it's just that the curves are nicely ordered by maturity on the left, and there are many crossovers on the right. So
no, we don't do beyond what I just suggested and hinted. Thanks. Yes.
I'm thinking that if we take a look at the curves in America, especially the United States, maybe it's not significant. It comes from the controversy in different states.
Yeah.
So if you can sort the portfolio by identifying the headquarters of the firm in different states, maybe we could have a positive.
Very good point.
Yes.
At the moment for us, North America is a region. We don't consider whether you are California headquartered or Wyoming. Yes, absolutely. Yes. Okay. Now what we want to do is, okay, fine, we have this CR. Is that a driver? Is that a determinant of the CDS? And in order to explain that, we go back to the CDS literature. It's an incredibly large amount of literature. And one of the repeating results is that de facto, pretty much everything is very strongly explained by stock return and the stock volatility of the underlying actor. And then if you want to capture the overall climate, as in economic climate, the evolution of the market, credit market climate, you can just use something that is called the median rated index. Yeah. So with that, what we wanted to do is we want to use the bare minimum amount of variable that should encompass and account for firm-specific aspect and market-wide aspect. So basically, this is capturing everything. Oil, changes in oil, shocks in oils is accounted in here proportionally for the nature or the tenure of the company. Yeah, so everything should be in there. And then we have a CR factor. Okay, so the very first hypothesis that I would like to discuss, or test that I would like to discuss, is, and I was just mentioning, this is a quantile regression on different quantiles. Think about 5 is the median one. If you move towards the 9 is credit worthiness is decreasing, so impoverishment of the credit worthiness of the company, and improvement of the credit worthiness of the company, moving from tau or 5 all the way to 1. Okay, and I would like to focus on these coefficients. Now, I know this table is a bit overwhelming, so apologies, but let me start with trying to think about cosmetics, how we can actually present things better, and I think we definitely there's room for improvement. So let's consider quantile 5. There are different maturity here: 1 year, 5 year, 30 years. Let's start from the 5 year. What you see is that the relevance of a carbon risk factor is decreasing in time. Yeah, so basically the cost, if they do materialize, they will materialize in the short run rather than in the long run. Or alternatively, another way of interpreting this, there is a decaying effect of the carbon and regulatory risk. That's absolutely in line with the literature that is studying climate change, where when you study physical climate change, whatever damage or effects will be very far into the future, whereas most of the transition effect will be probably more, in the near term future. Or again, you have time basically to accommodate for cost. You have time to accommodate for changing processes. You have much less time to accommodate for processes and business changes. Now, if you look the different marginal effect on the distribution of the CDS, you see an increase of the effect when you move towards the 9th quantile and the 1st quantile. That means that when you have a very large level of credit deterioration or credit improvement, the percentage, the effect of a change in the CR, the carbon risk factor, is disproportionately larger. And this is to the point that you were making up. So if you have a company that is in very high level of distress, and there is a change in the credit risk, and that particular company is in the polluting category, that is going to have a much larger, more pronounced effect, as opposed to a very small or even low effect or no change on the CDS at all, because these are the longer term CDS, the change in the CDS. Now, to put things into some context from an economic point of view, MRI, that is really important in the literature, is basically what captured the overall economic climate economy of the credit markets. If one standard deviation change in the MRI corresponds to approximately 6% of the change in the CDS, so it's a relatively relevant one. One standard deviation of the CR corresponds to 3%, so approximately half of the effect of the MRI. So there is a proportionally economically relevant effect.
And MRI also decreases sharply with time.
Well, I think is always a decay effect. This is current change in the economic climate, has a very low effect on
uncertain.
future. You can see these as a way of you've got time to accommodate whatever has happened now. Whereas here is you've got 1 year to accommodate.
Yeah.
How much can you do in a year? How much you can do in 30 years?
And also the longest further maturity, there is less differences across different types. So whereas at the beginning the peaks are.
You can think again is how.
So it's also
we
something that
can
you cannot
span.
distinguish over.
Yeah.
the different,
But it's also again you can think along the lines of how much time have I got to span any sort of regulatory change. And if you have only 1 year, because it's the tenure, well, it means that you might actually be in a situation where you're not able to replace. So this is the probability of default going up. Whereas here is will increase, but not as much as in a year's time.
And how do you explain intuition for the first, which are very?
It's the other way around. Because you have to think that the CR now is actually decreasing. Okay, the delta CR is decreasing. So there is you are expecting the two basically the polluting company and the cleaning company are now getting closer. Okay, so there is a smaller differential exposure to it's less risk coming from carbon, from regulation.
Yeah, although here it's the general results that you still don't have the part that comes later with the firms or the sectors. So this is the general perception of the market.
Average fair.
Yeah,
The average fair.
Yeah.
The average fair. Okay, regions. Here I'm presenting just the 3-year for Europe, 3-year, 10-year for North America. The only things I think is probably worth to point it out here is just the magnitude of the coefficient, okay, of all the coefficients compared to North America compared to Europe, and is an order of magnitude difference. So there is a clear, significant effect and relation, if you like, between the regulatory risk and the CDS of the companies operating in Europe, as opposed to companies operating in North America. Your point, we should probably test different headquarters, or we can even do something maybe slightly more nuanced. We can consider concentration of the operation of the companies. So instead of just looking at the headquarters, we can try to understand where is the footprint, the operation footprint of the company across the North American continent. Okay, now sectoral impact. So positive numbers means that your sector is affected positively by a change in CR. So if CR goes up, if the carbon risk the regulatory risk is going up, then there is an effect on the probability of default of a company, of an average company, even in a particular sector, okay, in a specific sector. And what we understand here is that building materials, energy, and utilities are negatively exposed to, meaning that an increase in CR is increasing the probability of default, and therefore has an effect, as a strong positive relationship between the CR and their delta CDS. But quite interestingly, there are certain sectors that are considered to be negatively affected, like, for example, industrials and technologies. And the way we interpret that by looking at the names of the companies that are actually part of these industries, that they are recognized to be part of the solution providers, actually, of a low carbon transition. So if you have a higher regulatory risk, that means that it's going to be more costly for you to reduce your emission, more costly. If you're a company that actually is providing solution, you're going to sell more stuff of your solutions. Yeah, higher level of cash flows, lower probability of default, therefore I'm buying less protection. The lenders are demanding less protection for this particular company, therefore a negative coefficient.
So where is hydrogen?
Hydrogen, okay. So hydrogen, I suspect that hydrogen is probably, I don't think it's actually technology. I don't think it's actually technology. I suspect it's actually. I suspect it's actually.
No, I don't think so. For now, in France, it's technology.
So it's actually categorized as technology. Is it in this? This is actually
Hydrogen is done
by some of the companies.
by companies that are startup-like,
Okay.
and then they are
They're not even-
commercialized.
No, they're
They're not even showing up
Not
here.
in the market
They're not even
because
showing up.
the CDS is for very big firms.
Right.
So this is also something to take into account. Those are giants. So,
They're very large companies. They're
yeah, they
extremely
are very,
large.
so the trading of the CDS is already, I mean,
Very
a specific
markets.
part of the market.
Yeah, that's why we wanted to look at CDS, because we were thinking, I know maybe it doesn't stand out quite clearly, but these are very well informed tests. So these the CDS traders are as sophisticated actually actors.
Yeah,
Very
these are the
sophisticated.
leaders of the market. But maybe the solution they are not going to come from them. But
Oh no, definitely not.
so
No.
they are too much established.
Okay. Now I don't. How much more?
It's okay.
It's okay.
Yeah.
Okay. So very quickly about these results, I think is I would like actually to dedicate more time to the next last result rather than this one, but this one is exactly connected to your point. This now an exponentially growing literature on constructing news indexes, attention indexes, concern indexes, you name it. The way they construct this is different depending on the definition of what you're measuring. What exactly is a news? What exactly is a new news, to be more specific? What exactly is a change in the overall concern of market participants? What is the level of attention, for example? There are few, fortunately for us. So we were actually lucky enough to ask these guys if they were happy to share their data, their news data. So we have a dedicated one for the North America, and we have a dedicated one for Europe. And we use that basically to control for the level of attention. It's in a way of accounting for sentiment in the market. So our worry was maybe everything is absorbed by this level of attention, and de facto CR boils down to be basically a very small difference between the polluting and the clean company. Therefore, it's not really much we can squeeze out from CDS. But we got lucky in the sense that there's still something relevant for left to explain for the CR. In fact, quite substantial. But there was something that I would like to test with you. There is when you look at Europe, let's fix the idea of 1 year and 3 years. This is something that probably again resonates quite well with you because you probably are quite familiar with the UETS. The definitions of these indexes is you need to use basically the innovation in the index, right? So you construct the index and then you look at the innovation. This is the new news, the new concern, the new attention. That new news tend to be actually old news in a way for Europe. So any sort of unexpected change in the CR is completely, in a way, part of the news. It's old news. There's basically not a big expectation about large dramatic changes in the policy. In other ways, what I'm trying to say is that attention and concern is not something that necessarily is of relevance for the CDS market when considering the regulatory risk for Europe, and is absolutely inexistent actually for North America. Okay.
So you mean like this the information that comes out from this even the delta is already obsolete for that market. So it has been already incorporated somewhere, and
Yes,
there's
exactly.
no reaction.
Exactly.
Well,
But
because
the
when it
expected
comes-
part
Yeah.
is already there. The unexpected is something different, but the expected part is basically not expected change in a way. So again, I think it goes back to the idea of credibility of the system, right? You might have changes in the regulation, but most of the regulation is here to stay, most of the climate package regulation is here to stay. Yeah.
So in North America, they believe that there will never be something that changes. So if they're staggering there.
But we cannot actually, no, well, we cannot really say much actually in North America. It's not
So it's
really,
not even.
it's not right, exactly. And I think drawing any sort of conclusion for North America would be a little bit of analysis. Okay, now the last one, the last result relates to the term structure. So thanks to the fact that we're using CDS, we can construct the term structure of the carbon risk. And what we want to test here is whether the possibility, the unexpected possibility of the introduction of more pressing deadlines, so speed at which you are demanding your industry or a particular industry to change, or higher level of ambition, whether this particular change that is going to be measured by a change in the slope of the CR is going to have an effect, a material effect on the costs of the company in the short rather than in the long term. So how do we do that? We construct two limiting cases. So we construct a CDS term structure where we consider 5 minus 1 year. So this is the term structure, what we call the short-term structure of the carbon risk. And then we have a long-term structure that is 30 minus 5. So basically the idea is what is going to happen between the next 4 years? What is going to happen between the next 25 years? And we try to quantify whether an unexpected change in the slope of the CR has an effect on the limiting case short term or the limiting case long term. And what you can see here is not much in North America. We were probably expecting that because we haven't seen much in terms of relationship even before. But for Europe, the effects, the potential effect on the short term is significantly larger than the long term. So this, we hope that this actually provides some sort of contribution on the debate, as I was anticipating earlier, on potential relevance for systemic risk. The idea is if you have unexpected change in regulation, that potentially going to land on the short term rather than the long term. So potentially generating higher level of unexpected cost that would reduce the ability of meet debt in the short term rather than, so next 4 years, rather than long term, the next 25 years. Yeah. Okay. To conclude, but very briefly, what do we do here? We were thinking in terms of, we understand the necessity to consider some sort of risk factor that is not just incorporating present information, but also what usually the market considered to be, or the literature considered to be forward-looking. And we tried to present a possible risk factor that we construct using CDS, credit default swaps. By doing that, we have something that is market inclined, because it's actually coming from the collective views of lenders. It's forward-looking because we have this different maturity, and it's a high frequency because we have daily transactions of the CDS. We demonstrate that there is a relationship between the CR itself, so it is a determinant of the CDS, and in particular is a much as an effect that is significantly stronger in Europe than in the US. Allows us to identify not just usual suspects in terms of negatively affected industry due to the presence of regulation, but also potentially positively affected sectors due to the presence of the regulation, just because they might be considered to be or perceived to be solution providers, or simply less exposed in a way to regulatory risk. We also provide some, we document that there is also an effect that is much more significant in the short term rather than long term for Europe. And once you take into account information, well, we do observe that there is an increasing demand for credit protection, but it doesn't completely vanish once you remove the attention, the evolution of attention indexes. Okay, with that, thank you. If you do have any further questions, more than happy to address them. Thank you so much. Yes.
I have a question about the political economy of regulation risk.
Yeah.
With the indicators that you use, I'm wondering whether they could be related, for instance, to lobbying expenses by the firms or things like that. Firms that are the most exposed to regulation risk could be they increase their expenses in terms of lobbying in order to reduce maybe that could be some extensions or maybe.
So there is a parallel project where we're trying to dig deeper into these cost of capital analysis, and then we're really truly going into all possible, like 360 degrees directions. So this idea of spending, lobbying, and spending in lobbying, probably something. Do you know of any possible data sets that we could use or consider, or any sort of proxy that we could consider?
Sure, I think that, for instance, at the European level, European Commission, I think that it should supposed to be public. I'm not sure about that, but the number of lobbyists at the European Commission is supposed to be public.
Okay.
I'm not sure.
Okay. So
That could be
one thing that we noticed here, and I think is already clear from the graph of the CR construction, is that and also I think the magnitude of all the coefficients that we estimate is that the CDS Europe market is really a different animal compared to the CDS North America. So we're trying to understand by interrogating literally the CDS trader, but also by reading the literature, whether we can say something about the information channel that is more relevant by a CDS in the European market as opposed to CDS in the North American market. So that distinction is something that I think is probably even coming before any sort of, like, are these guys spending money? But absolutely, lobbying must be something that you see here. There are actually companies that are that tend to be Suntime, Suncor, Dow. There was another one. I was the ConocoPhillips, the Chevron. So they are sometimes large funders of lobbying institutions. Absolutely.
maybe also in the political economy side, we're mentioning that, for instance, in the US, like where the headquarters of companies are based, maybe looking at Democrats versus Republican states or something like that. I think maybe that's one link even to policymakers.
Yeah.
Candidates.
So absolutely, I still believe that. I know this is a little bit of a boomer, but I'm sorry. But when you see here, I think that we can try to interrogate as much as possible the North American information. I'm not as sure that we're going to extract much more from here. I think that the situation is so much all over the place. We're still thinking an angle that we can take to do something a little bit more interesting in terms of discussion. But thank you so much.
Thank you. So if there are no other questions, thanks again for coming. And
thanks a lot. Thank you so much. Thanks a lot.